Imagine you just bought an asset. Instantly, the price plunges, triggering your strict stop loss in a blind panic. You're forced out of the trade. And then you sit on the sidelines and watch that exact same asset immediately rocket upward. The force driving this cycle is market volatility, the unpredictable price swings that make trading feel like a series of guesses. To protect themselves, retail traders often build rigid armor. They use a static 2% stop loss on every trade and keep their position sizes identical, regardless of what they are trading. But applying rigid rules to a dynamic environment turns normal market fluctuations into forced losses. The market functions less like a machine and more like a living organism that constantly expands and contracts. Survival doesn't require a crystal ball to predict where the price will go. Instead, it requires a ruler to measure exactly how violently the market is breathing right now. Shifting focus from predicting price direction to quantifying price volatility marks the transition from emotional reactions to risk management. In 1978, J. Wellis Wilder Jr. developed a tool for this specific purpose, the Average True Range, or ATR. ATR measures absolute movement over a 14-day average, ignoring whether the price is moving up or down. The indicator calculates the true range by comparing the current high and low, then drawing a connecting line back to the previous day's closing price. This specific calculation captures overnight price gaps that standard charts often miss. By factoring in these gaps, the ATR provides a mathematical picture of an asset's total volatility. If we replace a rigid 2% stop with a dynamic one set at a multiple of the ATR, like 2 or 3 times the daily range, the strategy changes. During erratic price swings, the dynamic stop extends downward, providing the trade with the room it needs to stay active. When the market settles into tight waves, the line moves upward, automatically tightening the safety net to protect your capital. A static stop would have been hit during the initial noise, forcing an exit before the trend could develop. These dynamic exits allow a position to survive normal fluctuations while remaining close enough to trigger if the trend actually reverses. This logic extends to position sizing, allowing a trader to standardize risk across different assets. A stock that moves $10 a day carries more inherent risk than one move in 50 cents, even if you invest the same dollar amount. When the ATR is high, you reduce your position size. When it is low, you can afford to increase it. Sudden spikes in a quiet asset's ATR can also serve as an early warning for a potential breakout. Conversely, an erratic ATR swing following a long rally often signals trend fatigue, suggesting that major participants are exiting. By adjusting position size based on these readings, you prevent a single volatile asset from having an outsized impact on the total account balance. ATR is a tool for measurement, and it operates within specific mathematical boundaries. A rising ATR only indicates that the price is moving aggressively. It does not indicate the direction of that movement. To build a complete strategy, you must pair it with directional indicators like moving averages or RSI. It is also important to account for major news events or earnings reports, which create artificial volatility spikes. These anomalies can distort the average for days, as the tool is designed to track normal market behavior rather than one-off shocks. Using this metric replaces emotional reactions with a strategy built on observable data. Volatility stops being a source of panic, becoming a quantifiable data point. Review your last 5 losing trades and apply the ATR indicator to those charts. You will likely find that those exits occurred within the asset's normal, expected range of movement.